I thought that it was a very interesting panel. We had the opportunity to discuss all the points that are relevant for today's situation in the banking sector as far as non-performing loans are discussed. Now, one good thing about the panel is that the members covered all the different perspectives that are relevant for this topic. There was one person that has an experience with an asset management company in particular. She's been leading an asset management company in Spain. There was the academic perspective, well represented. There was, of course, the supervisory perspective, which is myself. So all the complementary aspects were covered. Of course, there was no formal conclusion, but I think that it was clear that the present supervisory focus on non-performing loans was considered adequate and necessary by the members of the panel. And of course, one has to apply the right pressure on the banks, and the non-performing loans have to be resolved at the right speed, neither too fast nor too slowly, because that is important, that the supervisory action does not interfere with the credit process, and at the same time the disposal of NPLs has to be done as quickly as possible.
There was an inherent problem in banks' funding structure that stemmed from implicit government guarantees, and that most of the regulatory interventions following the global financial crisis actually aimed at undoing these implicit government guarantees. And that also means, of course, that bank funding costs are going up. So this is an intended consequence which made sense because we saw risk-insensitive pricing in banking, and we wanted to undo that. And this is why a lot of the conversations about profitability, etc., have to be seen in exactly that context, meaning there is an intentional effect on banks' funding costs of all the reforms.
Clearing of derivatives is an ancient business. It's been around for a very long while. What is new is that we are bringing this to central counterparties, and the regulatory framework is all new. So as this industry is evolving, growing, and as the regulatory framework is being implemented, this is an extremely important new center stage of financial markets with many systemic parts of the business. It's very important. And this is why at ESMA we are very eager to explain, and this is what I want to do today at the panel, to explain how the regulatory framework works, how it is currently being developed and implemented, also in cooperation with the national competent authorities who actually supervise these central counterparties, and what risks we see and how we cater for them. Empirically, I will also show what we have found so far in terms of our risk analysis, how the CCPs are performing in their new business function in this new world of CCPs in the European Union. And also, I will share a few insights from our stress testing exercises, which are exactly designed to show to what extent these entities individually will be able to sustain very hard stress, but plausible stress scenarios. And actually what we find is that they're doing pretty well at the moment, which is an encouraging first signal.
I'm going to predominantly focus on the aspect of international regulation and its potential impact in terms of competitiveness and capital flows and savings. Insurance used to be pretty much of a local business. Now with international capital standards emerging and international regulatory forces, it may have consequences that should be discussed.